everyone, I'm Laurie Ellison from Hudson Valley Bookkeeping, and in this video I'm going to teach you how to correctly post your mortgage payments and reconcile your mortgage statement. All right, let's get started.
Okay, guys, let's talk about putting a loan on the books and posting to it correctly, and we will follow this schedule right here. We're saying that the loan started in January 2022. Honestly, well, I'm going to keep this because I already printed it out, but normally on a commercial loan, it's 15 years, unless you did something with your own personal. But we'll just stick with this because I already printed it out. I'm ready to go. Okay, so the key to understanding this is what is the monthly payment, right? So before we start posting, let's just check this out. So this says monthly payment $27.67, but okay. The payment is actually $2,767.21. And so you'll see here is your principal and your interest. What I see go wrong a lot in bookkeeping for loans is the bookkeeper or whomever is entering data wants to split the check. Don't split the check, because inadvertently you're going to enter one of these pieces wrong. You're going to pull from the wrong line, and then it's going to take forever to go and find it. The other thing is, hopefully you're only doing one entity, one loan, one property. But if you're not, and you have multiple loans, or maybe two loans on one property, it's just so much easier to make sure you have everything correct if you post it using the monthly payment in full to your loan. Okay, so let's talk about buying a property and putting the loan on the books, right? We're going to decide, I'm just going to pretend that this is 100% financed. So first thing I do, just so you know, I switch to accountant view. Wait, it says I'm in accountant view. It doesn't even look like accountant view. It's crazy. Every time, depending on which version I'm in or which file, they all look different. Okay, here we are in the chart of accounts. We're going to add an asset. We're going to say it's an asset. We're going to go to fixed assets, building. Okay. I'm just going to call it that, purchase building B. Now, you're watching this video because of a loan, so we're assuming you didn't pay cash for it. If you pay cash for something, it's a lot easier and a lot cheaper. Okay. We're going to create the loan. I have other videos on posting a closing statement. We are not, we're not doing that in this one. If you have multiple purchases of properties, I like to put them by year and then their address or something. Okay. So we just bought building B. We need to put that here. So the easiest way, I hate journal entries where you go up here and you click new and make journal entry, and it's so hard to figure out which way, what you're debiting, crediting. I can do it all the time because I've been doing this for so long. But how much easier it is to go to this asset register, click add a journal entry. You know you're increasing your asset, right? You just bought something. So we'll say 1/1/22, purchase of building B, 100. I mean, they don't even let you do 100% financing. I'm just, you know. Okay, we're going to increase it by 500,000. Now you're able to pick your loan right here. Building B loan. So what does that do? Let me show you. Anytime you're posting stuff, go run your balance sheet, go run your general ledger for the date you posted it. Get really familiar with what you post, what it really does inside your books. You need to get really good at looking at that. And the first thing to do is always check your balance sheet. Okay, look, you now have bought a building. You now have right here a big loan, right? Okay. So that was first step. Put the asset and the liability on the books. Done. The next step. We are going to post all 12 months. So I'll pause this and I'll get the 12 months. I'll show you one. But then I'm going to pause it and let's say it's on auto pay. Well, so it would start in February. Okay, the payment is always $27.67.21. And I want to show you something. What you could do to make this easier for you is you could make it recurring. And you could also automate it. But I'm going to go here and say make recurring. I'm not going to do this in advance now. Well, why not? We're going to say monthly on the first day, and we could start it for 2/1/23. This is just my demo file, but why not? This one is scheduled, so I'm going to make a second one for my old ones. Go in here again. That's if you were due for future, okay? Then we're going to make recurring. This one's not going to be scheduled. I'm going to change it here, something so it doesn't match the other one. Save. Okay, so we already did. Here we go. So we got to post all 12. So if you're trying to post back for last year and trying to catch up right now, this is a good way to do anything with a recurring. So now we got March. And here's April. All right, and I'm going to pause this while I do the rest. I think I posted all 12, or actually 11 payments. They started in February, so there was 11. 2022 Building B loan. Here we go. Okay. So first day of the year, we took on a mortgage. Our first payment started in February. So then what I want you to do inside, and this is why I like a full payment, you can see if you are missing any, you just count out, right? So you just go February, March, April, May, June, July, August, September, October, November, December. If you go in your mortgage register and you're missing one of these months, it's probably, I mean, I'm sure you probably paid it. It's probably coded wrong. So that would be your first step. All right, so now we have correctly coded our year's transactions to this number. And now there's two different ways you could do it. Here, it shows the amount by month, right? So you're rolling down, and then we could add that up and total it. Some people like to put it, you know, all in at once at the end of the year. I think though, for purposes of always checking your loan balance, and if you or your bookkeeper are posting this each month and you have the mortgage statement with you and you see your ending balance, then this would be better to post it this way. If you have escrow, this would be another piece that you would still post your whole amount, and then I would make what I call an escrow bank account for that chunk of payment that they use towards your real estate taxes or insurance. But this is the simplest piece of it. But anyway, you could have an escrow piece. And then what you would do, I didn't even think about that. You'd make yourself an escrow bank account. And then as the bank mortgage company pays your, you know, whatever out of it, then you post that in there. Okay. So first month interest is $2,195.83 for February. So what we do here is go in your register for your bank, click add journal entry to Now we're gonna say, we're gonna increase the loan, we're gonna head back. Because sadly, out of this first payment, only $571 went to interest. I mean, went to principal. And this is where it'd be good if you had a class. I'm hoping you only have one in here. Okay. I'm gonna enter one more, and then what I'll do is enter the rest of these and come back. Now remember, your interest is so high in the beginning of a loan. I'm sure you know that. Okay, I'm gonna enter the rest and come back and show you what happens next. Okay, guys, so I entered all of the entries, and this is what it looks like if you pop a balance sheet. So this shows the checking payment going against the loan, and then me adding back the interest as a journal entry. And then what you'll see is that this running balance, this says $493,575. Now it's off 5 cents from this, but this is just a fake online one. So, 5 cents, we're not gonna worry about. So this is 493,574.95, and my printout, when I do it here, is this. And I was just looking at some of the payments. It's like a penny here, a penny there out of the 11 payments. So that's not a big deal. If you're ever off and you're, like this, just true up to whatever your bank statement says. When it's pennies, it's just immaterial. So let me go again, and then we could look at interest expense. I don't know if I have any other loans on these books. And let's see if we count out 11. 1, 2, 3. I'm missing June. So I bet I put it in this other interest expense. So this is what you want to do. You want to look. So there was this, here it is. This is why this chart of accounts really should be numbered. I don't. There we go. These are the things you need to look for. So when you're going in and you're checking your payments on your loans, count out how many months the loan was in that year. If it's a typical year, it's 12. For this one, since the loan originated in January, first payment was in February. And again, then you can take your printout, like I printed this amortization schedule, and you're going to follow along. And that's the funny thing is that mine matches this exactly. So it's just the rounding on this schedule. So I've seen that with banks. They could be off a penny or two or 3 here and there. It's very immaterial. Don't waste your time worrying about pennies, please. And then what did that do to our loan on the books? As of the end of the year, wait, I'm in the P&L. Our building's still 500,000. And the liability is down a whole whopping 6,400 and something from the original. So just remember your interest in the beginning is quite high. So that is how you would post the purchase, post the loan, and so forth. I will, as a bonus, just show you what I was talking about, escrow. Okay. If you have escrow, and now this will make this not tie, but that's okay. If you have escrow with your loan, I would like you to make a bank account and call it escrow bank account. Because technically what's happening, and this happens like with your property managers and different things like that too, right? So the bank, you're paying the bank an extra $500 a month. Let's say it could be 1,000, could be 2,000 and on up. And that is going in to a special account for you, which they have to put interest in So usually you'll get like an interest statement that is for the purpose of paying your property taxes and your insurance. So let's just say that in your mortgage, just how I was posting out the difference. So let's say your payment was higher than 27, or let's say it's just that, but out of that $500 every month went into escrow. You would add a second journal entry for the escrow portion of your payment. So 2/1/22, let's say $500, we pick escrow. I'll just add one more and then we'll do a thing. So loan is going to be paid off even less now because when more money was taken out. Okay, so let's say that's every month, it's $500. So now we have $1,000 in our escrow bank account. What the bank will do is this will keep going up. Then they will get the bill to pay your insurance. So out of this bank account, let's say they pay, you will get the policy. The bank doesn't do that for you. Travelers. Right, that's your job, but it may be part of your loan terms that you have to pay into escrow. Most loans do, but I had one of my first house, it didn't have. We had to pay that separately, our insurance and so it's not definitive that you have escrow, but if in case you did, just split your payment out more. But go back to the basics, you pay the whole amount to the loan and then you break out your interest and your escrow. So in this piece, this escrow is not an expense. It's just movement of your money basically from your bank account to another bank account where it's piling up money. Then let's say $400, the bank got the bill, has to pay for your insurance. And it would be property insurance, right? And then let's just spend it all. They had to pay the receiver of taxes. Or maybe your school tax, something. Now here's something could happen. Let's say they pay $750. Now you got a problem. Because they will do then what's called an escrow analysis. They are going to then say your $500 is not enough. And we are going to change your payment to $700, but now you need to pay us, $300 to get you back out of this negative. So that would be, you might get a bill, like from the bank, from your mortgage company that's saying, we're changing your escrow amount. And not only that, but we need you to give us $2,000 right now to get you out of the negative. So that's just like a whole other piece. But honestly, guys, I tie out escrow accounts like I do bank accounts. I mean, I was on training last night and the person asked me how they could become better and how, to really level up their skills. And I said, one of the most important things you do is reconcile everything. Don't blindly post things and hope it went well. Get into these registers, check your balances, check your balance of your mortgage balance, check your balance sheet. You should just look at it constantly. And I think I do have some videos on what's most important, but I would be in this balance sheet all day long. So look, right now my cash account's negative. That's fine because I was probably just posting things to get, to show you guys stuff. But see, escrow bank account negative, you'd want to go look at that. If this wasn't a dummy file, you'd want to see why your cash says negative. You want to look at your accounts receivable all the time and make sure that's correct. What if you're posting your rent from your bank feed and you're not supposed to because you've been making invoices? Okay, so if this isn't correct and you realize, oh my gosh, I posted all these payments just straight from the bank to income, you got a problem. Maybe just if your cash basis, just go void those. You want to check your assets. Your assets should never be negative. The only thing that would be negative would be accumulated depreciation, which we stick right underneath our asset. You should check your security deposits. Are they accurate? Has anything happened? Does this prepaid rent, have you earned the rent income? Do you need to break that out and bring that down? Does your mortgage, whatever you have on your balance sheet for that, match the statement? If it doesn't, go figure out why. Okay. I think that's it. I hope you find this helpful on posting a mortgage. All right. Have a great day.